Consumer Price Index was up almost 2% year over year in January. That was an acceleration from December. Our guest says that with core inflation measures both up 2.7%, the Bank of Canada should stop cutting rates for now, in March anyway. Let's bring in Shelly Kaushik, Senior Economist at BMO Capital Markets. Great to see you.
Hi, Andrew. Thanks for having me.
So you think the Bank of Canada will be well advised just to stand pat on March 12th?
Yeah, I think inflation and economic activity more broadly have been firming up to end the year and to start 2025. And I think it behooves the Bank of Canada to kind of slow the pace of easing as it looks ahead to potentially stronger inflation pressures to the upside.
You're not saying halt interest rate cuts altogether. You're open to the idea they could go on cutting this year.
Yeah, in fact, we still have 2 more cuts penciled in for the Bank of Canada this year in April and July. It's just slowing the pace of easing. And that's just reflecting the fact that there still are some downside risks, especially to the economic outlook in light of all of the tariff uncertainty. The slowing more so just reflects the fact that domestic activity so far has actually firmed. And so they're just trying to balance the two-sided risks at this point.
You're saying that 2 crucial measures of core inflation were 2.7% higher year over year? That sounds well above where they want to be.
Yeah, it's certainly above the 2% target, and it does reflect some of what we're seeing in the headline inflation numbers are actually getting some support from the fact that we, of course, had the GST, HST holiday in effect for the entire month of January. So we are seeing some upside pressure on core inflation, and I think some of that disconnect can be explained by the tax holiday as well as by some outlier components that aren't necessarily in core.
Now, you mentioned inflationary pressures that may be coming. Do they include tariffs?
Yeah, I think the prospect of tariffs certainly would push up prices, especially once you include the countermeasures from the Canadian government. At this point, there is that two-sided risks. If we get to the point of tariffs being implemented on Canadian exports to the United States, we would have, that upside risk to inflation, but also the downside risk to growth. And so that is really where the balance comes in.
We've seen the Canadian dollar actually rallying a bit lately. If we could put up a 1-year or 6-month chart, it's managed to get its head above 70 cents. So I guess that might reduce the Bank of Canada's fears about really pushing our currency down unduly.
Yeah, it certainly does help mitigate some of that immediate risk on the currency, but we do think, the tariff threat is still very much real. We are looking ahead to early March, which is just in a couple of weeks. And we do see some additional downside pressure on the loonie if we do end up having tariffs of any of the possible tariff scenarios that we have seen into play. If those do come into play, then yes, I think we could see some further downward pressure on the loonie.
But the Canadian economy generally ticking over okay? I know growth is not great. It's less than 2% as far as I know, right?
Sure, yeah. It has been firming up a little bit. We've been seeing that in the labor market numbers and the retail spending numbers. We're actually going to get December retail sales at the end of the week. We are looking for a bit of a rebound. And of course, inflation, 3-month, 6-month annualized momentum does seem to be picking up a little bit. And so the signs are there for a bit of a pickup. Of course, it's not across the board, but it's looking like lower, at least the past interest rate cuts that we've seen from the Bank of Canada are starting to make their way to support economic activity.
And what about the labor market? Because if I remember rightly, in the latest figures, our unemployment rate was down.
Yeah, and that was certainly a nice surprise. I will say the outlook for the labor market does lag other economic indicators. And so we are expecting to see a bit more deterioration in the coming months and quarters. But looking ahead beyond that, I think the unemployment rate will benefit from, an expected pickup in economic activity. That said, of course, everything does come down to tariffs, so whether they are actually implemented on Canadian goods and services, or at least goods on a broad scale.
So it looks as though the projections for this year, next year from the Bank of Canada are a bit less than 2%. Doesn't sound very exciting. I know that's after inflation, but it's not really, it doesn't sound like a very vibrant economy.
It is a bit under potential growth. I would say that even on our end, we have actually lowered our growth estimates for Canada. We're at 1.7% for the year, and that's without including any tariff scenarios, but that does include the risk of tariffs. So even if, best case scenario, even if Canada is not hit with meaningful broad-based tariffs, the risk is there and the risk is meaningful, and that in and of itself does impact the economy most directly through business investment. And so it weighs on business spending and investment plans. And so that in and of itself does weigh on the growth outlook.
It's a perennial problem for our economy, isn't it? Low business investment.
Yeah, it really is. It is something, yes, that's certainly beyond the most recent tariff hit. But yes, it is something that I think policymakers are watching quite closely as well.
And we just go very quickly back to core inflation.
Sure.
What is keeping that higher than the bank would like to see?
I think we are still seeing some upside pressure from shelter costs, although they are coming down. That has been quite significant. We are also seeing some relief, I should say, also on the food aspect. And I'm pointing that out just because that is, of course, something that's top of mind for everyday Canadians. Of course, getting your groceries every day. So we are seeing some relief as well as some continued upside risks. But because I did mention food inflation, of course, that was one of the aspects that was impacted by the sales tax holiday. And so we will start to see some of that reverse as well in the coming months.
As an economist, I'm going to try and tempt you into politics here. As an economist, what do you think of a temporary sales tax cut like that?
Well, I mean, temporary is temporary, right? We knew as soon as it was announced that this sales tax holiday would not be permanent. And so I think when consumers are making their spending decisions, they're not necessarily going out and buying more. It's not really a permanent cost of living adjustment, right? It is more so a factor of just shifting your spending, whether it's, maybe you're not spending so much on Black Friday sales, you're waiting for the sales tax holiday a few months ago. So, it's a temporary tax cut is not going to have the same impact as a permanent one, that's for sure.
Shelly, thanks very much.